Hey guys, welcome back to the channel. So this wasn't the video that I was going to make today. The idea for this has actually changed twice, and for good reason. I want to take a moment just to maybe anchor people in some investment principles that I think are needed right now, given some of the news that we're hearing and the fact that we're actually dealing with the September effect, which is basically this notion that in September, historically and statistically, the markets don't perform well. Typically, on average, the S&P 500 performs 0.5% worse off than previous months. And I want to talk a little bit about that and simply just ask the question, is your head in the right space right now? So let's talk a little bit about Evergrande and China first. If you don't know who Evergrande are, I mean, they're all over the news right now. They are China's second largest real estate developer, and they have just defaulted on $80 million worth of loan repayments. And this has sent shockwaves through the Chinese market. Now, being the second largest developer in China is a pretty big achievement, because there's historically China has done a lot of development. It's a big country anyway, but they have done a lot of development over the last couple of decades. I mean, this is the country that would build entire cities really within a very, very quick period of time. Now, the market cap for Evergrande is, from when I last checked, about $24 billion. They have $310 billion worth of debt, which means they are massively over leveraged. They are, again, one of the largest real estate developers out in China, which means that you have, according to the numbers, 1 million people who have deposits down on properties that now look like they are not going to get built. This really does hark back and is reminiscent of Lehman Brothers 2007, 2008, the market crash, the catalyst being the property market. The number of people that the collapse of this company could potentially impact in terms of job losses is rumored to be around about 4 million people. 4 million people. That's a lot of people to be impacted as a result of this company potentially going bust. And when you start looking at, how people actually accumulate and hold their wealth in China, and part of the GDP, the contribution that the real estate sector has to the Chinese GDP, you start to see the scale of the issue here. So apparently 20% of the Chinese GDP is actually wrapped up in real estate. So again, Evergrande are the second largest retail real estate developer in China, which means that they will contribute a large proportion of that 20% to the GDP of China. Now you look at it from a domestic private investor point of view, 78% of wealth in China is actually wrapped up in real estate, which is a huge, huge problem. Now, Evergrande defaulting on its debts, some will argue, has been on the horizon for a very, very long time. You look at the share price is down 84% year to date compared to this time last year. This isn't something that has come out of the blue, but it's certainly something that has been exacerbated as a result of COVID. Now, the obvious question here is, well, with all of this and everything that we know now, is this likely to impact people here in the UK or people who have invested here in the UK? And the answer to that is yes, there is going to be an impact, but the question is, how much of an impact is there going to be? At the moment, we don't know that, because ultimately what we do know is that we have investment houses, Vanguard, HSBC, BlackRock, who will hold exposure to emerging markets and certainly to companies like Evergrande. Now, if they're defaulting on their loan repayments, because of the way things work out in China, they are going to default on foreign investors before they default on domestic investors in China, which means that if you have BlackRock with exposure to Evergrande of, throwing a number out there, 400, 500 million, well, it means that essentially that exposure is going to be impacted if they're defaulting on foreign creditors first. That is just the cruel reality of it. And I think that if we see more providers with exposure to these companies within that region, then yes, there is going to be an impact on the investments that we essentially hold. And this really brings me around to the investment principles that I think are really important for us to make sure that we anchor ourselves into. And the first one is this idea of whenever you are investing, diversification is really, really important. On the live on Sunday, and actually for the last couple of weeks that I've done lives on a Sunday, I've got a lot of questions around investing in emerging markets like China. Well, the problem that you have with the likes of China is the reporting isn't often that reliable. And we saw that in this case of Evergrande, where they have been basically saying that they're going to be okay. That's what they were saying until they came out and said, well, no, we're going to be defaulting. It felt like it came out of the blue. And when I talk about diversification is all about spreading your risk globally. No one's saying don't invest in emerging markets, but it is about understanding and weighing up the pros and cons of investing in that economy or in that part of the world. And this is where I preach religiously about investing in ETFs and index funds that are going to give you that kind of diversification at scale, in opposed to picking individual stocks. The question really that everyone's going to be asking that we don't really know the answer to right now when it comes to the Evergrande saga is, how much is this going to impact the overall economy in China and other sectors within China? Evergrande, yes, they're a real estate developer, but they're also diversified into retail parks. They're also diversified into electric vehicles. So if they do collapse, is it likely going to impact other sectors as well? We know that there is going to be an impact domestically, but what's going to be the full extent of it, and how is it going to affect investments here in the UK and for anyone who's got exposure to them in the UK via investment funds? But the idea here, and what I want to really kind of drive home, is diversification is absolutely key. If you buy in individual stocks, you got to understand that you've got really, really high risk, and diversifying with index funds and ETFs is a great way of actually doing that. At least you're going to be employing the skills and the expertise of a professional investment house to help you make those really hard investment decisions and do the research that you're not going to be able to do as a retail investor. I think maybe the last thing that I do want to end on is the question that I asked at the beginning of the year on the podcast and actually here on this channel. What are your goals? When you first invested that £100, that £50, and it was your first investment for this year, what goal did you attach to it? What was the reason? I say this all the time, and I think sometimes it gets taken for granted, and I feel like a broken record saying this over and over and over again. But I can't help but come back to this, because ultimately your goals will dictate what you invest in, why you invest in what you're investing in, and how long you invest in what you invest in. And if you are a retail investor, a first-time investor that was just investing because it was fun and you didn't really have any goals, or you just heard about a particular stock and all your mates are doing it and therefore you wanted to jump in and do it, then if you're looking at your portfolio right now and you're down and you're worried, it is a natural place to be, but you need to try and think about what your goals are and anchor that into your goals, because your goals dictate everything that you do, what you invest in, like I've said, and it will dictate what actions you take in moments like this. But what should you do if you are in the red? I'm going to tell you the same thing that I tell everyone. Don't sell. Don't sell. Yes, it's a loss at the moment and it's on the screen. It's a red. Yeah, you've lost money on paper. It's not real until you cash it in. And so if you can, wait this out. This will pass. We were here March last year when the pandemic initially hit and lockdown initially rolled in. Things were down. We're going to be here again at some point in the future. This will roll around again. It's all about holding tight. It's all about holding your position, not cashing in until you're back over your original place. Never cash in a loss, essentially. And you know, at the end of the day, if you are the kind of person that you have some capital available right now, then just continue to invest in the markets, because guess what? Now you're going to be able to buy shares, you're going to be able to get invested in index funds and ETFs at a discount, at a lower price than what you would have got it at yesterday. Very, very simple, but I think these fundamental principles are really, really important. I hope that makes sense. I'm going to do a live Q&A tomorrow at 9 p.m. So join me for that. I hope you've enjoyed this. It wasn't the video that I had planned, but you know, we roll with the times and we roll with the punches. But guys, keep your head straight, keep your head in the game. Remember, money's a tool, life's for living. This is a long-term game. It's not a short-term return kind of thing. Just keep your head in the game and remember why you did it. Think about your goals. Catch you later on.